There is inflation, which makes them want to buy hard assets across the board, whether it be high-end pens, watches, cars, art. The auctions are still very, this is a very unusual recession, if indeed we are in a recession, because you've got so much capital still on the sidelines, over $4 trillion cash. So worldwide. And so, this is not your grandfather's recession. Plus you have full employment right now. And the Fed, the big debate is what is the terminal velocity of that interest rate? Is it going to be 5? Is it going to be 5.1, 5.2, 5.3%? We just don't know yet. Rates are down today after the latest data. So, there's a disconnect between the Fed pounding the table saying we're going to keep raising rates and what long-term bonds are doing. They don't believe them. And so, it's a very unusual situation. The Fed can keep making noise, but it's not working yet. And certainly it's a tight labor market. The housing data has rolled over in there and it's not reflected properly in this CPI 6.5. The real CPI, if we actually were to take true pricing of housing in major markets in the US, whether that be semi-detached, rental units included, standalone homes, certainly office and industrial space, that has rolled over, and it is representing a too high an inflation rate inside the CPI because the data they use is 11 to 18 months old. So that's why you're seeing this disconnect in the bond market. Anybody that buys bonds, a fixed income balance sheet investor like me, knows exactly why these spreads have tightened, particularly on BBB credits. They don't believe that inflation is actually 6.5%. Inflation may be as low as 5% right now if we were to true up the data from the housing market. I've still kept the ratio of 30% fixed income and debt to 70% equity because I find equity is still more attractive. The way I look at equity now for the balance of this year, anybody that forecasts past a year, I don't know how you can do that, but right now I'm assuming the Fed is going to slow down a little bit and probably not pass the 5% terminal rate. And while they wait and see what happens to the economy. So most companies are starting to really cut costs any way they can. But there's been so much productivity with technology over the last 3 years that they've been doing a very good job of that. So you're going to see some earning revisions at some point. I don't anticipate any expansion to PE because we're still sitting at a 17 PE. So I don't think that's going to go up. So now I'm looking for companies that A, are cash flow positive, B, do distributions of profits. So in other words, they take the cash and they distribute it through dividends. Some of them will do share buybacks, but not now that's being taxed. I think the dividend is going to be more popular.